Dealers, last chance to join our dealer chat groups. Initial groups are forming now. Registration closes on November 25th, and we won't open new groups again until April. If you want real operator-to-operator insight heading into the new year, join hundreds of top dealers at cdgcircles.com. I'll see you inside. Today, I'm joined by Jim Keffer, CEO of Keffer Auto Group. Jim runs one of the rarest models in auto retail, decentralized stores run by unicorn operators who can buy 100% of the dealership over 10 years. He breaks down how the model works, why it outperforms traditional structures, what he looks for in elite GMs, and how he finds underperforming stores that can be doubled or tripled with the right leadership. A big thank you to our sponsors for making this episode possible: LotLinks, Cox Automotive, and CDG Circles. And now let's get into the show. Jim Keffer on the CDG podcast. Jim, welcome.
Thank you for having me back.
Thanks for coming back on. How's life been for you, Jim?
Well, life in general has been very good because I think that's a choice. Business wasn't as exciting in October as I would have liked. A lot of people, I'm sure you get on the show, they'll always tell you it's wonderful, and I think the term is always "we're rocking" or something similar to that. And you know me, if the baby's ugly, we just call it ugly, and it was kind of ugly last month. I think some of that was brands and environment, and some of it is us. So always stuff to work on in the car business.
What do you think? If you divide that, what do you think is on the brand side, and what do you think is more internal right now in terms of challenges?
Yeah, well, we'll probably talk a little bit about our model, but a function of our model is we try to buy the brands that are associated with lower multiples. And there's a reason for that, right? You probably get less natural traffic at a Stellantis location than a Toyota store. And so, they're making some headway at Dodge, Chrysler, and Jeep. And I think doing some positive things, but it's not putting them on the same same playing field as Toyota just yet. But the other component of it, and the thing that is always my hot button, is used cars. And when you hire people and give them a high degree of autonomy, maybe more than they had where they were before. You sometimes find out that, somebody else handled maybe the marketing, or maybe somebody else handled used car acquisitions or other areas like that. So I think some of that is the growing pains of people getting their arms around some of those positions if maybe someone else had been doing it where they were before.
Mm-hmm. Yeah, you definitely, the more decentralized you are, the more you need a unicorn in a way to be proficient in every single department.
I think that is the exact perfect analogy, and that would make me a unicorn hunter, which may not make me always very popular in some areas. But I think, that's sort of what you're looking for is the total package, the person who can do inventory, advertising, and people. And, if you look at the Publix or even the bigger dealer groups, by design, they box in the artsy parts, which would be the inventory component and the marketing. Those use different parts of the brain, right? And if you just go find and you buy a Toyota store, all you really need is a good leader who can put a good team together, and it's not as hard to hire a good team at the Toyota store as it might be at the Mazda store, let's say, right? So you need that person that is really a special individual. And often, though, when you find that person, they thrive in an environment where they can be entrepreneurial. But it is not without its pitfalls because, that the highs and lows can be higher and lower. If you are missing one of those components that maybe a corporate structure would fill in.
It's actually incredible, the model you've deployed here in your dealer group, and we'll talk all about it for those that aren't familiar, but you run a decentralized model and you provide GMs a path to full 100% ownership in the group within a decade.
Right, that's correct.
And we'll talk in more depth about it shortly, but I think one of the most incredible things that I've thought a lot about this model since you first told me about it. And one of the most incredible things is that in the corporate world, we're sort of taught to centralize, to, economies of scale, and I don't come from the corporate world, but let's just, let's just say we, for sake of conversation here, you're taught to, compartmentalize different roles in order to not have to find unicorns, right? To simplify, to grow the talent pool.
Right.
And you have sort of, when they zig, you zag. You've kind of taken the complete other direction, and you have product market fit based on, your scale and success, where, like you said, you're a unicorn hunter. And I think it'll be a pretty fascinating conversation to dig into that.
Yeah, it takes a little intestinal fortitude, and I have been accused of doing it the hard way for many years, which I would say is probably a fit, but I think a lot of times the best things in life come from the hard way, not necessarily following the rest of the crowd. So, I'm still comfortable with that model. As I shared, it's not without its pitfalls, but it feels good to me, if that makes sense.
Well, let's not keep the audience on a cliffhanger. I wanted to start a little further back of what inspired you, but let's just talk. What is the model? Like, give us the Spark Notes version of this model.
Yeah. So the very, very short model is, my dad got put into business in 1974 by a guy who put him on a 10-year buyout, and so you buy 1/10 each year, out of the bonus that comes from a year-end kind of bonus. So in order to make that work, even in a brand that has lower blue sky, it's a very aggressive compensation package. So you have the regular GM comp, and then you have a year-end component that goes towards buying stock. And that, if it's operated right, and we've done the math correctly to size out the potential for the store, then the GM has the ability to buy that deal out from me 100% over 10 years. And then at the end of the 10 years, they buy the real estate at appraised value and send me a Christmas card or something fun like that. And that's a real oversimplification, but it really requires looking generally for deals that have a pretty big upside. And I think most people, when they're in the buy mode, are either looking, I want to go blue chip, I want to buy this store that has a great team in place and has great cash flow, and I'm going to pay a premium for that, but I don't think I have much to fix here. And so that gives you sort of like buying a stock that is paying a 4 or 5% dividend. You might not get the upside that you would get buying some AI startup, but it's a stable return. We are really going in the other direction and saying, hey, we want to bet on the person, the guy or the girl that we think can operate at double the output of the average. So even if you're giving up a lot more of the pie, and more of it over time, it allows you to attract those unicorns, as you mentioned. And if you did your due diligence and you guessed right within the interviewing process, then unicorns don't do 10 or 30% better. They do double or 3 times better. So it creates a good return. And it's not for everybody, because there are a lot of really good gigs out there right now that you kind of get it on the rails, and you have this brand that's going to get traffic. It's going to get great trades and all of those things. So all you have to do at that point is keep the wheels on, and you can become a good golfer. I stink at golf, by the way. I would love to get better, but probably starting at 60 is not the smartest thing to do. But anyway, that's kind of it. It's for the people who really have that entrepreneurial spirit, and they don't want to be the guy who comes, 10, 15 years from now, and they get the, oh, you sold out, and who's taking over now, and am I still going to be here in 60 days, right? So the only way to really control your destiny is kind of to own that, and we've provided that opportunity. And as I said, my dad got that opportunity, and he devoted the rest of his career to doing the same thing. I got introduced to janitorial services at a very young age, and so I didn't have a whole lot of excitement around this whole car dealership thing as a kid. In fact, that was the one thing I was never, ever, ever going to do. But I never had any kind of epiphany. I never was like, wow, the sky parted, and this is the thing I'm going to do, my purpose in life. But I kind of looked at closer at what my dad did, and it was really life-changing for our family. And so I think, well, that's a pretty cool deal. Let's continue that on and give other people that same opportunity. And yes, you can make a reasonable return doing it. You're not going to build the same kind of empire as if you kept all those billions of dollars of revenue for yourself.
This episode is brought to you by LotLinks. ChatGPT can write emails, plan trips, even tell jokes, but it can't tell you which VINs are at risk of sitting too long, how your dealership performs against your competition, or how to improve your VDPs. That's where LotGPT comes in. It's the only chatbot built exclusively for car dealers. It knows your market, dealership, and inventory. Fueled by LotLinks' decades of VIN and shopper data, plus your live inventory, Google Analytics, and CRM, it delivers relevant answers and guidance to help you sell cars faster and more profitably. LotGPT is free for dealers, but invite only. Join the waitlist now at lotlinks.com/LotGPT or click the link in the show notes below. Wow, that's an incredible story. How many of these have you done, of these buyouts?
33 completed. First one started in 1979, and I was still very young, but my dad, once he got his legs under him, decided early on with his backers' support, like 5 years in, let's go do this some more. So it has been a great ride for us. It is a very evolving landscape, though. It's much harder than what it used to be, right? Because one, the difference between sort of the haves and the have-nots, the Toyota franchise or the Lexus franchise that's worth $100 million isn't very approachable for a guy who wants to do a 10-year buyout, right? That doesn't.
It won't pencil. Yeah, it's going to take him 50 years.
No, and I still remember when my dad passed on the Toyota store in Charlotte many years ago because he thought $2 million was way too much goodwill, so there are lots of those funny stories. I missed Subaru that I could have bought for $500,000 a bunch of years ago, but it's all about how much cash and people you have at the time the opportunities come along.
It's like there's this meme online where it shows a baby in a crib in like the 90s, and it's like point of view, me in the 90s sleeping in my crib instead of buying a house for $30,000.
Yeah, well, I think it just goes back to me maybe being destined to do it the hard way. But if the hard way helps a lot of other people get the same opportunity that I've been afforded, then I'm pretty cool with that.
Have you never considered, keeping 10% minority stake, no control in any of these deals? Is that not like a non-starter for you?
No. I haven't really thought of it. It's just not the way, that's not the way that we have done it, which doesn't make anything a good idea. But it's like, okay, I can keep an annuity, but you're
essentially,
you're sort of advertising, an all-in opportunity to have your own thing, and even if I'm just there in a little piece, I'm still there, and that's not just completely you. So, I'm not the one making it a great operation. I'm always going to give experience and opinions, but it's up to them to turn it into something great, and if they do, then that should be theirs.
And I get it. Like, you have a certain ethos and a brand, and even 0.1%, it just breaches that. That's the difference. So I can understand where you're coming from based on what you're describing.
Yeah, you never know what the way that deals have to get done in the future to afford people this opportunity will change. And, you always have to be willing to adapt, but I don't foresee that, right now as something that would be in the cards.
Now, in terms of the blue sky, so you do a deal. Let's break this down a little bit. You do a deal. Mm-hmm. What is the cap that you've identified as like, hey, if a deal is above X dollars, it will never function within a 10-year buyout?
Right.
Or are you thinking like, hey, the government wants to do 50-year mortgages. Maybe I move to 12-year buyouts so I can afford some, more expensive deals over here. I mean,
Well,
how are you?
Years isn't going to change the math much, right?
Yeah.
So if you take a deal and you break this thing down, let's say we're buying a deal that we think can do $2 million if we operate it well and do a really good job in used cars, right? So if we pay, ideally $2 million in goodwill, because right now the store is losing $50,000 a month, right? And we have an exceptional operator who can turn chicken, into chicken salad. Then, okay, so let's say that it makes $2 million, and maybe they go in, but first you would look at the deal and you say, okay, it's going to have, say, we're going to probably put in $1 million for 2 months worth of expenses. Let's say it's a $500,000 expense store. Then we're going to have $300,000 worth of assets. That'd be a low number, but for ease of math, and then another $200,000 in parts, and then maybe another $500,000 for owned used cars. So that then maybe you borrow $1 million. Now you got a $3 million deal. You borrowed $1 million, and now the total upfront money that you're putting into it is $2 million. So that means that if the net book value didn't change at all, you'd end up having to pay back $200,000 per year, right, to buy the stock. Now the reality is the net book value is probably going to change because as you grow, dealerships eat cash. You sell more cars, and now I have more contracts in transit. Now I have more receivables. Maybe I have to buy more parts. Maybe I have to fix the roof. Any of those things are going to eat cash. So usually the first 3 years, we're not taking much in the way of distributions, not because I don't want to, because I would like to take the money out and then rinse and repeat and do it again. However, you have to maintain your working capital standard, right, along with other bank covenants that even though they may not impose those, we put them in as a good discipline because we're trying to teach people to be good business people along with good car people, so that when we're not in the equation, they don't make money and go broke at the same time, because it's very possible, right? So in that model, somebody's got to have after-tax dollars of $200,000, but if you're in the deal and let's say you're making $10,000, 15% of the net, and you're getting another 15% at the end of the year, you've got plenty of money to both live on and buy stock, right? And that's the way that it has to work. So what's the right amount to pay? I think the right amount to pay is whatever you think you can make within 3 years, because the first couple of years maybe you're bumping around, getting your legs, figuring out what the market is on used cars and the right equation for marketing to get people in the store. And of course, you're not going to be perfect, whoever the GM is, in terms of building their team, right? So usually you have some ups and downs associated with that, but it really makes the number, not much more at the max of 2 times what you think the store can make to be able to get it paid back. Does that make sense?
It does. What I'm trying to understand now is if it's 2 times more than what the store makes. So you basically have to find broken deals.
Well, yeah, I don't want to be disrespectful to anybody I ever bought a deal from, but certainly underperforming based on what you think it could do. And that could be in the fixed ops. It could be maybe it's overexpensed, and you have a legacy dealer who had a lot of people, right? And so it could be overexpensed, or there could be a fixed ops deal that you see bigger upside in. So you're just looking for the way to sort of unlock the potential, because you got to remember that the gross that you do, the additional gross over what the current guy is doing, that's going to fall to the bottom line. If your numbers are lined up at, say, 35% for comp, then it's going to drop to the bottom line at 65 cents on the dollar, right? So every additional dollar of gross is going to add a lot more net than if it was the first dollar of gross during the month. And to understand that, you have to kind of understand the idea of what's the marginal cost to sell a car. And we do a lot of looking at that, right? If we're on the last day of the month and we're going to sell one more car, what are the expenses going to go up? Well, they're only going to go up by what we had to pay the sales guy, the F&I guy, and the sales manager, and maybe some benefits or something like that. So if on average that adds up to 35, 38%, there's a lot more gross dropping to the bottom line and net at the end of the month. And the same is true when you go into something that has a lot of upside. So if you can add to that, and at least it's not losing major money currently, the increase in performance is going to have a disproportionate or exponential impact.
Mm-hmm. It makes sense. You at that point you have leverage and you've covered your overhead. So like you said, it's rolling to the bottom line. Tell me about finding these stores. Like, what's a tougher pipeline for you? Finding underperforming or severely underperforming stores, or finding these unicorns that can run these stores and do a good job at it?
Yes.
Both just as tough.
Yeah, no, I think my favorite statement to all the people that I work with, because I think you learn over the years that it's really not about you. You might have started with this S on your chest thinking, hey, I can leap tall buildings and all that stuff. But, I've gotten my teeth kicked in enough times to know that it's not about me. It's about who you can find, right? So I think you should only recruit on days that end in Y, and I can tell you that I've had lots of conversations at my house on a Sunday, which my wife just understands, because that's sometimes the only
by the way,
time
Sunday is the recruiting day. Sunday is the recruting day.
Yeah, well,
it's the best.
I try for Sunday to be the pottery day, but it doesn't always work out that way. If you have the right kind of person that you have an opportunity to talk to, you take that meeting 100 times out of 100, right? Because the unicorns aren't 1 in 10; they're 1 in 700 to 7,000. That comes from a guy named Elliot Jacks, who wrote a book called Span of Control. Really cool guy is a trainer called Tom Foster that you can find on YouTube if you want to understand a little bit more about that.
Mm-hmm. It's so true. I mean, you need to, it just feels like in this business, where a majority of the industry is Monday through Saturday, not everyone. It's Sunday is this day. It's like, that's the feeling I always just, when I associate with Sunday, it's the day where you have that 2-hour phone call with someone you've been wanting to speak with, and you guys really get to know each other.
Yeah, and we may have talked about this the last time. I think one of the challenges that kind of everybody faces at some level or another is the invisible finish line, right? In life, people have there's two opposing opportunities, and one involves time and the other involves money. Right, but once you get enough of one, you want more of the other, there is definitely a dichotomy there, in that it often requires sacrificing one to get the other. But if you're in a very attractive compensation mode, you can all of a sudden find yourself not really applying as hard as maybe you did when you started. Because it's time to reward myself. Now, that's not a conversation you have out loud, but it is a conversation that happens nonetheless, and it shows up with what kind of vehicles are in your driveway, and are you willing to take that call on a Sunday, or do you have other more pressing engagements on the golf course? And I'm not throwing stones at anybody for any of those choices, but sometimes people will find their finish line before I was finished. And I think there's still more upside there to really improve the most lives and provide the highest potential for all the people in the store to have their best outcomes. And so always a balancing act, right?
You mentioned a book. So there's an author named Morgan Housel, and little brag, he's a follower of Car Dealership Guy on X.
Cool.
And so he Housel. And he has a couple of great books. He has one called The Psychology of Money, and he has one that he just released called The Art of Spending Money. And this is an interesting one, because he just talks about, our psychology, our biases, why we spend on certain things, how to spend, when to spend. Again, it's different for everyone, but he shares many different scenarios, it's similar to what you just said, right? There's different seasons in life where you're optimizing for a different thing. And so it was, I find all his books very interesting because he's a very clear thinker and, a great writer. But I highly recommend, I think based on what you just described, I think you'll really enjoy, especially the art of spending money.
Add it to my list. I think close analogy to that, I just got finished with Deion Sanders' book. One of the people in our leaders group recommended it. It was called Elevate and Dominate. And I was more of a Barry Sanders guy, score the touchdown, put the ball down, or give it to the ref. Not all the stuff. Deion was, the prime time flashy guy, but it's really kind of a unique story. And I guess the Cliff Notes version would be that he was amazing as a dual sport athlete and did things that nobody else had ever done. But he ultimately ended up in his life in sort of a dark place where he didn't feel fulfillment, right? So it's kind of that whole notion of what you chase that helps you get there may not ultimately be what provides fulfillment or fulfills purpose or whatever you want to call that. And that's really where this coaching thing that he's doing came in, because it was this way of building other people up,
training others. Yeah.
So I think it's also a great book. If I listen to it on Audible because as soon as I read, I'm like 10 pages and asleep, so I have to do it in the car.
This episode is brought to you by vAuto. Do you know what's quietly killing your margins? Inventory aging. The average car sits 45 days before getting shipped to another store, hoping it'll sell faster somewhere else. But guess what? Once it lands there, it usually sits another 30 days. On paper, that looks fine. In reality, that car's been tying up capital for 75 days, bleeding margin the whole time. The fix? Get the car to the right store on day one, or move it before the clock runs out. Because every day you wait, you're losing gross you'll never get back. Check out vAuto's new guide on centralized inventory management by clicking the link in the show notes below. That's great. And it's sort of one of the most exciting parts for me, just to say about what we do. It's, we're a ton of work to do. We have a lot to grow and more impact to make, but I feel like we have an opportunity to democratize knowledge, right? And bring it to the industry in a way that hasn't existed. And that's what drives me. I think that's just a super cool, rare and unique opportunity where we can really, impact so many different people and lives and organizations in a specific industry. It's like you said, there's different ways to achieve that in different industries, but I think that's at least one of the big things that gets me excited. It's being able to impact, just like you're creating wealth for families. You're putting people through. You're providing opportunities, and again, they're earning them, but you are providing that initial opportunity, and you're helping them really get, change their lives, their families' lives, their grandchildren's lives. It is pretty incredible.
Yeah, I mean, I think I'm not going to break my arm patting myself on my back. I just kept doing something that my father got started that I probably never otherwise would have done. I would have liked to think that I would have chosen something that had some upside for someone other than me, regardless of what it was. But, I have really enjoyed following what you guys are doing. I think it does bring sort of this unique perspective and some varying. I think one of our winning ways is embrace diverse perspectives. So, you're not just going with one line, you're introducing different things, but I think it's very kind of raw or transparent or whatever you want to call it. And I think that's why it's engaging so many people in the car business. So, my hat is totally off to you. I think conversations like this are fun for me, but people really, it seems to really resonate with them.
Well, I appreciate that. And I also want to thank you. I know you're a Circles member, CDG Circles, which is our new our peer group. So my man. And you're an executive member. So there's your call. So I want to ask you, let's get back into the tactical. Mm-hmm. And that is when day one, you structure these deals. what do the economics look like, right? So you found a deal. The deal is $2 million, right? Now you found the talent, which I assume you, like you said, you're always having conversations. You got to always maintain the pipeline. Understandable. What does day one look like? Are they putting up cash day one? How much of it are they? What do they buy in for? What can you tell us there?
So, people can go in with up to 25%. I will tell you, historically, most of the deals are no money down. Everybody gets a car dealership. It's just what they bring in. You have to think of somebody else in their perspective. They've saved all their money most of their life to have this opportunity. Now we're going to go into this, potentially broken store. Do I want to stick all of my money right in? So we give them the opportunity to, try before you buy. So you're going in as a GM, with a buy-in opportunity or buy-in agreement from the first day. And it makes the most sense because of the way that taxes work, because it gets a lot trickier if you're doing mid-year buy-ins, to have like the first equity purchase that happens after a December statement. So then the accounting folks are doing their review or making any adjustments, because otherwise you could be charging somebody for something that is getting written off or depreciated or whatever. And so that's the cleanest way to do it. But then, the rest of it is whatever you start with. If you take the remainder and divide it up over 10 years, you can buy that much per year. Or, if you have a skinnier year, or, you need to pay for tuition for your kids to, have 12 kids in college or whatever it is, then, you can buy whatever portion you want. But it obviously works better if at the end of the rainbow, at the end of 10 years, you have at least 50%. If you're performing, the store's doing well, at the end of 10 years, even if you own 50% of the gig, you're going to be able to get hooked by a bank, and we'll make those relationships available. But also we start the people in the service contract component of it, so they're participating in that as well. And if they perform well in that, then they can take that money out at the end or borrow against it and use that to help buy real estate.
So is the value that I'm paying predetermined to avoid me creating value, right? Improving the value of the business and then paying each month or each year a higher price? Or how does that work?
Right. Now, here's the thing, right? If we were reevaluating the dealership, and there have been some structures like that, not in our group, but in others that I've heard about over the years, where, okay, you go buy something broken, and then you get this rock star to tune it up and make it worth a lot more money. And then you start saying, okay, well, I'll sell you whatever percent. That was the deal up front. But now we're going to value it based on what you made it worth. So now we're adding a goodwill component to the
That's the issue, yeah.
Yeah, we don't do that, right? But let's say in this deal that we bought for $2 million goodwill, and then we had all the working capital, but we got a total of $2 million in it. It makes $2 million. Well, then you're going to pay a management fee at the end of the year, because I'm not taking money out, and I don't have a certain amount of a pack per car that comes, any of that stuff. But after you pay taxes and management fees, then what's left? Let's say it was $1 million. Now maybe because we started out the store was selling 70 cars, and now we're selling 150. I might need that whole $1 million just to keep the wheels on this thing, because we have a lot more contracts in transit than when we started. We have a lot more payoffs that we have to make on cars that are trade-ins, and the incentives that are there that we're sometimes waiting as much as 90 days to get the money. All that takes cash, right? So we have this notion in a lot of cases that cash and net profit are the same thing, but they're not. You have depreciation on the goodwill, which is over 15 years, but you also have the pay down of the loan. So that's where we want to avoid, if possible, having giant loans, because then that payback on the loan is not expensed, so it's not hitting your net, but it is coming out of your cash, right? So it gets a little complicated, when you look at all the puts and takes. But at the end of the day, when you do your annual buyout, you're doing it based on book value. And the book value, if it's higher, was only because we needed that cash to run the store. and that cash some of it was mine, and I don't want to sell $1 for 50 cents, but it's not about adding more goodwill because you made the store worth more money.
Got it. So goodwill is not factored into the increased value, but then what's necessary to run the business is.
Correct. And in fact, the goodwill is getting depreciated by, I think $1 million over 15 years is like $5,555 per month. So the actual goodwill that you're paying on is going down by 65 grand or so a year. So you're making it worth more money, but paying less in terms of goodwill, but more overall because the cash that's required to run the business.
What do you look for in talent? I know we talked about, you're hunting for unicorns, but what does your interview process look like?
There's a really good book. We do this a lot, referring back, but a book called Who, the Top Grading Method for Identifying A Players. And the old saying is very true that success leaves clues. You want proven winners, right? And to the extent that you find people that are proven winners, then if you want to look for a bias, the bias would be used cars, right? Because that's the controllable. Especially if you're going to go into a market that was a broken or underperforming store, and you're going to try to turn that up. Well, it takes some time to convince the people who, went to other brands to come back, or that have never, been in. And so that means heavy marketing and, a lot of trial and error. And while that's happening, you need to be able to sell used cars, not used cars that were trade-ins because you're not selling the new cars. So you have to be able to go out and acquire cars, right? And so again, it goes back to, was this the guy who was in a store where somebody else was doing that? Or were they really personally responsible? Because that person that's personally involved in that process is usually able to move the needle faster than anybody else. Doesn't mean the other people can't. It just takes more time, and they have to bring that talent with them.
There's definitely a level of creativity and also just combining multiple disciplines to be a strong used car retailer. To your point, I equate
it to day trading. There's a lot of variables. If you're going to step up and start spending money and buy in the ups and downs in the stock market. But, you think about it, like if you're at a Chevy store, how many different configurations are there in a new car or truck times the total number of packages and models and colors? That's a lot to figure out on the new car. And we have tools for that, right? You can get Conquest or whatever. But then you go to used cars and you're taking that same number of variables, but you're multiplying it times every brand and the last 15 model years. That's a lot to kind of get your arms around and really know the ins and outs of which vehicles have which specific sorts of problems and which ones do you have to make sure you have the pano roof and the adjustable seat or you're screwed. All of that comes into play. And I don't care, Dale Pollock is I know him as a super guy and a genius, but that's not giving you the leg up, right? When everybody has something, it just allows you to reach parity, not really.
It's commoditized, yeah.
Yeah. So, they sort of democratize, to use your word, used car information, but that doesn't give you an advantage. I think you really have to be in it. And you have to do a lot of evaluation with conversations about what's working and what's not working, and have some spirited debates. And what I can tell you for sure is it is not a one-person affair, right? You can't go hire that person and now all of a sudden you've got a great used car department. That's not happening any more than that you could go hire a really good BDC person and throw 1,000 or 1,500 leads at that person and think that, it's just all going to be fantastic, right? So I think the evolution of the car business requires us to become internet dealerships and used car cultures. Those things have to be embedded, not, we go hire somebody for that because, I want to be good at that. I did say it's not about me, but it takes a whole team of people to be good at those aspects of the business. There's just way too many variables to think that one person can handle it all.
And what about other than their used car performance? I mean, what else is important to you?
Well, we look at their sales efficiency. I don't want the person who can sell used cars, but they're 60% sales efficient, because that doesn't put us in a position to maintain favor with the factories. But I'm also going to look at what their CX is. What is their gross per unit? Because there's a component there where, okay, I can do volume, but back to the marginal expense. If it's costing us $1,400 just to pay the F&I guy, the salesperson, and the manager, and maybe that's okay. But if on average the person makes $1,300, well, there's no amount of cars you can ever sell that's going to make that turn into a good equation, right? So people who can do volume and gross, if you're getting picky, it makes them an even more rare unicorn. But then I also want to look at what are their Google ratings, because the customers will usually give you the best indicator of whether it's a great experience.
You're based in North Carolina, and you are putting stores in different areas, different states. Have you had a situation where you set up a store far from home, and for whatever reason it did not work out with the operator, and now you were stuck? I mean, have you had this type of situation? Because I know a lot of dealers who I speak with say, look, I want to keep them close to me, out of sight, out of mind.
Yeah,
also, I just want to be near my store.
It's definitely a better play if you can do that, but you have to go back and look at the math, and turns out you can buy Chevrolet stores for less in Minnesota than Florida. A lot more people want to be in Florida, and I think the answer to your question is, have we ever had a deal that didn't work out, far, far away? We've only recently begun to go that far away, and I don't foresee that happening, that we won't be able to turn something around. If you did, however, you'd take your lumps and go on. But, also there is usually a pretty good list, if you're recruiting on days that end in Y, of other people who would like to have the opportunity. So, you
have a
don't
pipeline, yeah.
sit on your thumbs and say, well, gee, let's hope this works out. And, if it doesn't, then, we'll start thinking about, something else. But, so we talk to people all over the country. And, if nothing else, it's almost like listening to one of your podcasts. You meet a new person and get to hear their car story, which I always start with because I think it's really fun. Like, most people didn't get into the car business on purpose. They sort of backed into it or fell into it. And some of the coolest stories ever, and some of the best entrepreneurs I've ever met. So, that makes it worth the conversation in and of itself. But yeah, you've always got to have a backup plan for your backup plans. But you I think also should approach it with eyes wide open. And if you do your math right, and it was based on sales efficiency and averages and things like that, you're not trying to take a moonshot, to make the deal work.
Jim, do you think someone can be taught to be an owner, or is that something that is innate in a leader, in an operator? And I know you, I don't mean like so matter of fact, like you clearly have put lots of aspiring partners in aspiring partners who are presently GMs into these positions. But I'm coming from the perspective, like, is there a personality trait that you look for? Like, can you really, do you know when someone is like, okay, so they check my boxes, there's this base pattern matching that I've identified, they can be it, or it's like they don't have what it takes from an ownership mentality or anything like that? Can that really be taught? What's your take?
Yes and no, right? Because you can approach it from a lot of different angles. There, you can be, you could be an introvert, you could be an extrovert. How leadership shows up isn't the same with each person, but it can still be effective. But you're going to start and do your homework to make sure that the person's values line up, right? And, you're not hiring an axe murderer. And then, you've got to also kind of figure out how they are with the business side, right? There are some people who are very good at selling, but not great at math. And so you try to talk through that with, their understanding. You don't necessarily have to understand a financial statement inside and out, but the biggest thing is sometimes the very best sellers are one step away from being manic. They're like 10 feet tall and bulletproof until they're not. And people have this self-destruct mechanism because, the people who really push to the edge sometimes forget where the edge is. And you've got to make sure that you have somebody who's willing to be honest with themselves. And if they're not, usually that will show up, sort of in background checks or references, right? And I sort of love, because you have to appreciate people that are sort of the savant seller, but that isn't all it takes. It's not just about making a dollar. You only get paid on the dollars you get to keep. So you have to try to have that balance. But I would find in general that it is easier to take the super high performer and teach them how to take the business factors into consideration than take the really smart person who can't close their fist and teach them how to be driven and dynamic, because people in the car business are attracted to shiny objects, and A players don't often want to go to work with somebody they don't perceive as an A player. And since we are loaded with extroverts in this business, they associate sometimes A player with somebody
loud, boisterous,
who acts like them, right? And the best equations in most cases are not 3 or 4 exact duplicates, right? You have to have the person who's the driver, and that person sometimes ruffles feathers. You have to have the person who keeps the wheels on, and that person is good at administration. And then you have to have what I technically call the fluffer-upper, because that's the person who glues people back together after the administrative person, told them they couldn't do something a certain way, or the driver pushed them a little harder than maybe they should have. Sometimes you can find somebody who can play all of those roles, and you want people who can all be productive, and make a contribution on the growth side when it's necessary. But everybody's going to have their own strength. So putting a diverse team together where you have those different components is where I've really seen it be. It turns into magic, and it's really fun to watch those people, because it's usually a lot of debate between that team.
This episode is brought to you by CDG Circles. Running a dealership today takes more than it ever has between new technology, regulations, and constant change. But the hardest part is doing it alone. I've been there. No one to call when things got tough, no place to ask what's actually working for you right now. Is this vendor legit? How would you fix this problem in your service department? And much, much more. And that's why I built CDG Circles, a new kind of peer group for top performing dealers. With Circles, you get a dealer group chat, structured sessions, real-time conversations, all with the full confidentiality, antitrust compliance, and a group of dealers who actually get it. Our goal is to end the isolation that costs dealers time, money, and clarity. We're not a 20 group. There's no travel, we're not retrospective, and we don't group you by brand. Circles is for dealers who are looking for in-the-moment insights. Almost like having a personal sounding board of top-notch dealers who are playing on your level. Over 1,000 dealers joined our original waitlist, and this month, we've officially opened up signups to additional founding members. So join us and be part of the first wave taking the car business back into our own hands. Join us at cdgcircles.com or click the link in the show notes below. When you say team, diverse team, are you referring to in-store or at the corporate level?
In-store, yeah. Yeah,
In-store.
At the corporate level, I want to be reasonable, prudent, predictable. You shouldn't be going in 6 different directions. And I'm sure some of my guys would tell you that I've been guilty of it, before in my life. But the intent is to try to create a sandbox or a platform or whatever you want to call it, where somebody has a good understanding. It's another one of our winning ways is getting clear on the expectations, right? These are the results we want. These are the way that we would measure it. These are the key metrics that tell us where we are. This is the report they're going to show up on, and here's the meeting on the calendar that we would expect you and your team to talk about it. But there's also ones where we would like to show up to be able to at least hear the conversation.
You mentioned different talent bringing different positives, some drawbacks, and I'm curious, how do you complement the drawbacks in certain people? Right. As you identify them, like where maybe they're a stronger numbers guy, but, weaker on, I don't know, in-store operations, whatever it may be. Do you have a method? Like, how decentralized are you? Or maybe with accounting, right? Do you have a method for complementing?
Conversations, right? You have to separate everything up into buckets of it. Is this a leadership issue? Or is it a management issue? Because you manage processes and stuff, you got to lead the people, right? And sometimes you have somebody who may have good processes, but they're not getting executed on. So that could show up as a lack of perceived urgency or whatever. You just have those conversations, right? And, I just would tell somebody, this is what it looks like, and if it looks like that to me, it may look like that to somebody else. It doesn't mean that's what it is. But I think that, you're either getting results or you're not getting results. And if you're not getting results and we did a good job of creating forecasts, then we're looking at the gaps. And, sometimes conversations about why lead us into excuses more than, other things. And so you try to frame it in the way of sort of funnels where it's either leads closing or gross, right? And so now that doesn't become about a personality. It's, if we're practicing blameless problem solving, did we have the number of opportunities we needed? Did we convert them at the same level that we should have? And we're measuring these things. And then did we get the margin that we were planning to get? And is that margin somewhere in line with what the industry is doing? Or, again, is it less than we're paying out to sell the cars, right? So you try to create a model that isn't like a moving target. This is all the data. We did it based on data. And then it's your job as the person who's the operator to work with your team and collaborate with them to say, how much of potential do we want to chase after? And that's sort of how froggy do we feel, right? And you hope that they feel pretty froggy, because if not, then we're really telling the team, maybe I don't have that much confidence in you and I'm going for the layup. And if you don't stretch people, they often won't stretch. But that is more usually, sort of up to the people in the stores. And our job is to play kind of point counterpoint and challenge assumptions and, you play devil's advocate in some cases, but not to challenge authority or ability. It's really just to say, hey, here's what the numbers say. How are you looking at that? Because there's a lot of different ways to skin a cat, right? But again, there's no way that selling cars for less than it costs you just to pay the people is ever going to turn, I don't care how much volume you do, all you're going to do is lose more money, right?
I think one of the most incredible things about this conversation is that if I'm a GM, I want to work for you because I think you're laughing, but I think the upside, right? If I'm truly driven and I want to be an owner, the upside is limitless. And get this, and I'm sure you've thought about this, but as I think about your business model, you're sort of like a Barstool Sports for car dealers. Let me explain for a second, and not in media. So, these media companies, what they do is they find talent, they put you on a contract, and the difference is that you don't buy them out after, X amount of years. Rather, you become so much more valuable because you've grown together that you go on to another, firm, or maybe you re-sign with them, but it's unlikely. And what you've done here is you're doing that, right? You could say this for any business, but I think it's especially pertinent in this case. But you are an expert people picker who is just disguised as a car dealer. You're a leadership. You're a leader factory. All right. So all that kind of CDG pontification aside, I do have a question for you.
I deserve, like if I was all that good, I wouldn't be holding anything back for my guys to try to help them be better at used cars. But that again, it's a pitfall, right? When you give people the autonomy, then they're going to take that. And even if I did give them advice, it doesn't mean that they will always take it. And there are a lot of, I'm not saying this out of humility, it's just the truth, right? Then I'm a numbers person, and our numbers historically have been very good. Currently, they have room to improve. So we're working on that in the same way that we always do. Just by the same things. And I try to be the kind of person that would be good to work with. But to some guys, I'm probably like Chinese water torture, because I'm at least going to keep showing up and having the conversation. Like I'm like the kid in the back seat. Are we there yet? Are we there yet? But not because I want to be a pain in the neck, but because I am invested in people succeeding at a high level, right? I'd like to make myself the smartest picker, but hasn't always been the case, and nobody's perfect in that regard.
Well, Jim, success leaves clues, and I think I noticed a couple of things about you, right? I mentioned a book right away. You write it down. We launch a high-performing peer group. You right away are first in line, say, hey, I want to be part of this. Those are the clue I see there is that you're a lifelong learner, and you're always looking to improve yourself. At least that's based on two just quick assumptions. Go ahead.
I think anybody who's not hasn't been paying much attention. I mean, if you look at the car business today, and you're not trying to learn, you must have behind. Some kind of death wish. But I've always been sort of a thinker. When I was a kid, my friends in high school called me the philosopher, and I don't know. That's just sort of how I was geared. But I'm not necessarily the smartest guy, but I tend to learn well. So I learn slower, and as a function of that, I have to put in the work. I'm not the person that just shows up and hears it once and then I know. And I wish I was better at that. I would have a better golf game. But I'm still trying to work hard, because I think that is a responsibility you have. If you're going to ask other people to follow, and even if I don't want them to be reliant on me, I'm asking them to follow the model and become self-sufficient and be very successful. I've still, asked them to subscribe to something that I'm leading, and with that comes a responsibility to do your part, and not doing that is disingenuous, but also a recipe for a headache.
Jim, before we wrap up, have you ever, I'm still thinking about the price ranges of deals that you go after. Have you ever considered creating like a, alternate model where you syndicate capital and you still let the primary GM, eventually operating partner, buy you out, but they keep like a third party in? I'm just thinking, like, is there a path for you to be able to unlock bigger deals? I
have looked at that, right? And there's some good partners out there in the market that are doing that, and I think it's worth people looking at, because and that's some guys, I don't want to deal unless it's this big, right? And like if let's say you own a third of a store that does $6 million, okay, great. Now you own the equivalent of a store that does $2 million, and you have other people involved. So I'd rather be, at least at this stage of the game, because if you're going to go pedal the bike, great. Growing for growth's sake doesn't do much for me. If there was a person or entity that was better than me and provided a better opportunity and would do the same stuff I do, I'd hire them and get the hell out of the way so everybody could do better. But most people don't want to follow that model because, as I shared, has peaks and valleys, and it seems almost dumb, right, to get something to the point where it's on the rails and now the other guy owns it and you get nothing. I can't find a source that wants to do that. I've had because being a student of the game, that's what you have to do. You have to understand how the other people are playing the game, and who you're going to compete with for different kinds of deals and growth and people capital. And there's some good models and really bright people out there. I'm sure some of them will be at our meeting in Colorado in June, and I look forward to meeting them. And I don't think that it's a one size fits all kind of thing. I've been doing 20 groups since I was 13, right? And what I learned is there's a lot of right ways, and so
there's multiple ways to the top.
I still have to stay open to how do we do this in the future. I'd love to find somebody who I can figure out the math, and long term, whenever I decide to hang up the cleats, then I'm selling to the people that are the operators in the long term stores. The other guys are already on buyouts, right? But you have to have a path for the management company, all of that stuff. So it's things that I work on all of the time, and consider different ways to do it.
Super cool.
And, so hopefully I'll continue to be a student but figure out a good idea.
Yeah, and I understand your perspective. Like, you're not getting a bigger multiple on your exit or anything. So why do more work when, at the end of the day, a part of it is, like you said, just building for, like, what are you really building for? What are you getting out of it? Are you bringing anything additional to the table? But it is something interesting that came to my mind. It's like, can you unlock a new tranche of, deal sizes by syndicating some capital in certain cases?
Absolutely can. Guys like Larry Morgan and David Hudson are excellent at that. Both super smart people, that have great organizations. Different model, though.
Yep. Incredible stuff. We didn't even get to certain topics here, but I do want to ask you one thing, and it's you're a student of the business. We spoke about this. I did see you had some notes on, Carvana's model, getting into the industry, into the new car side. And I would say, more generally speaking, what do you right now observe in their industry as this, like, upcoming wake-up call it the canary in the coal mine? Like, what are you seeing, right? What are you anticipating based on all these, breadcrumbs, all these little things that we're seeing happen in the industry nowadays?
There's a couple of things, and I think if you are a student, then you always recall that history repeats itself. So you kind of look at what's going on in the industry right now, and when CarMax first started, they lost a bunch of money consistently. But
on the new side,
on the new and the used car side,
and the used side,
because they were starting with people that weren't car people and figuring it out with a huge amount of inventory, and that comes with a wake, but they were able to sustain the losses. And that's one of the things, back to this idea of scale, that you have ways of using other people's money and taking a shot at things that take several iterations to get right, and eventually they got it very right. Call it whatever you want, but there was a lot of people in the industry back then that were saying, well, this won't last. It's just not, people want to negotiate, all of those things, right? And back then it was somewhere around a third of the people preferred not to negotiate. But I thought to myself, even then, what a brilliant model. If you can only get a third of the market, who would not like the third who wants to pay sticker? I mean, I'd like that third if I could get them. And they had a really cool model. And so it hung around. Now you fast forward, and Carvana was losing boatloads of money. But now they've gotten over the hump, and because now maybe there's up to 40% of the people who would prefer not to negotiate, and this online experience. But the other thing that you know about that is companies that don't have higher employment costs are going to trade at higher multiples, right? Because the marginal cost to do business is lower. And that's why software companies have huge multiples. And so you really have what's sort of a software company getting into the car business, at the same time that Amazon, but Amazon is doing it kind of still through the dealers. Carvana has managed to now sell close to 500,000 cars, and they're profitable. So that doesn't mean that the entire world is going to go to that model, but Carvana and CarMax are sucking up about, I forget what it was, maybe 3% or 13% of all of the direct purchases from off the street because of their model. And so acquiring cars against them is a very challenging thing, right? And so I think that the fact that they've become profitable now means that we have to pay closer attention and determine long-term, how do you compete with them, and the digital retailing that isn't really mainstream even still with Roadster and all the other solutions that are out there. It's still a very small percentage of the business. Has to be something that you continue to pay attention to.
Well said. Jim Keffer, Keffer Automotive Group. Incredible conversation, Jim. One of my favorites as of recent. This was really fun.
Cool.
Thank you so much for coming on.
Happy to be here. I appreciate the conversation.
I appreciate you, Jim. Thank you.
All right.